After a quiet start to the week with much of the Northern Hemisphere on holidays, the markets warmed up by Tuesday, with the RBA keeping our official rates on hold as expected, but surprising market participants with its lack of commitment to future rate cuts, which pushed the Aussie dollar back above 75 cents. As we've said for the last few weeks, we don't see a more dramatic fall back below 70 cents in the short term, and the chart here shows that the Aussie has held up well above the 71.5 cent mark, mainly because the market seems to have overcommitted in its confidence in the US economy and the pace of US rate rises. Adding to this effect, we had US Fed Chair Janet Yellen admitting that the poor US jobs figures may push back the next hike from July to August. Meanwhile, coming back home, our central bank's comments took the Aussie sharply higher, and then the Reserve Bank of New Zealand added the impetus for the final assault on 75 cents as they resisted the temptation to ease rates in New Zealand. It's all about central banks at the moment. Europe's attempts to shock their economy into action by imposing negative interest rates in the EU may have come across a stumbling block, with Commerzbank, one of the largest lenders to German businesses and households, revealing that it is considering keeping its spare euros in safe deposit boxes and vaults rather than on deposit with the ECB. Why pay the central bank for the privilege of parking a deposit with them? Although the logistics of this may be debatable. In local news, the ANZ job ads data was better than expected, with a 2.4% jump in May month-on-month and a 9.1% rise year-on-year. So, business confidence, hiring intentions and consumer activity are holding their line, despite us being in this long election campaign and the risks of a hung parliament. We'll get a full read of the jobs market on Thursday, when the unemployment rate is likely to remain below 6%. And finally, the data out of China has been pretty mediocre, but the latest trade figures show that while their exports have slowed, China's imports, including notably our iron ore and coal, continue to power ahead. Iron ore imports in May were up 22.5% year-on-year. So no wonder it was the net exports that were the key factor to our recent GDP growth rate. How broadly the benefits of this permeate the Australian economy is another question. But China's demand remains a helpful bridging factor until the transition of our economy post the mining boom is fully established. And that's the market update from Bendigo Bank.